All right. Thank you guys for joining us. This is the President's Forum of Houston, Access to Capital for Continued Recovery and Growth. We've got a really interesting panel today. I'm excited to be your moderator and your host for this session. My name is Basim Tafilai. I'm a commercial banker with Bank of America here in the Houston area. I've been in banking since 2006 and kind of help small, lower end middle market companies access capital for all kinds of different needs. We've got a great panel today. I'm excited about the speakers and the participants that we have, and I'm excited about the group that we've had today. So we want to talk a little bit about format before we get into the actual panel discussion, and then I will introduce everybody, and then we can kind of go from there. So as you see, we're in a Zoom style meeting today. So feel free to keep your camera on or off or whatever's comfortable for you. But in the near term, please kind of keep your microphones on mute just so that we're not talking over each other. We have four panelists today with different kinds of backgrounds in the finance industry. And what we're going to do is we're going to kind of have a discussion about access to capital. So the way that I kind of see this going is I'm going to kind of start off introducing everybody and then I'll have everybody on the panel just give a brief little sentence or two about themselves, and then we'll start with some questions to kind of get the discussion going. But I want to make this as interactive as possible. So to the extent that you have questions, kind of right off the bat, I'm gonna start with a question or two, but kind of right off the bat, if you have questions, we want to go ahead and let you guys start asking your questions. And then if there's a pause or if people are kind of gathering their thoughts and their questions, I can kind of fill in with some other questions as we go. But I really want to make this a discussion to make sure that all the participants get as much out of it as possible. So please don't be shy about doing so. You can either ask your question directly over the microphone, or if you feel more comfortable putting it in the chat, feel free to do that. And then I can either call on you to ask a question, or I can read it out for you, whatever you prefer. As I mentioned before, we've got a great panel today. On our panel is Brett Fenn. He's a capital markets originator from SunTrust, now Truist Bank. He's been in the industry for over 17 years, and he covers commercial and middle market banks industry and specialty advisory platform for Texas, North Carolina, and Tennessee. We've got Steve Keston. He's the head of business group and shareholder at Houston law firm Boyer Miller. He's been he has over 30 years of experience and almost 20 years at the firm. He specializes in mergers and acquisitions, private securities, private equity, venture capital transactions, and general corporate law. Elliot Smith, who is our third panelist, is a founder and managing partner of Flat Bay Capital. He has been in the industry for almost 20 years now, been working mostly in the asset-based lending space, and his company focuses on private commercial real estate bridge lending for transactions between over $1 million. Chris Heisinger is a C-level executive with VCFO. He has nearly 20 years of experience in leading energy organizations and corporations in Texas. He has extensive experience in executive management, financial management, capital markets, financial hedging, and risk management. So we'll kind of get started here, and I'm gonna ask each person to kind of just give a brief kind of discussion about what they do at the banks at their institution, and then we'll get into the questions. So if we could start with Brett, just give us a little bit about yourself.
Yeah, I appreciate it. Great to see everybody. I think the bio did a pretty decent job, but kind of over the almost 20 years between JP Morgan and SunTrust, now Truist, it's really been focused mainly on privately held companies. There's been publicly held E&Ps on the upstream oil and gas side, but really the passion is privately held companies, and there's a lot of reasons for that. But what I currently do is assist kind of local relationship managers for growing privately held folks across a bunch of different states, but I'm based here in Houston, with anything that's kind of growth capital, and that can span all kind of stuff. But we're seeing there is so much to do, whether it's from the real estate angle or it's the partner buyouts or anything with expansion, that there's really no shortage. And as you've seen, banks have really moved into the specialty groups. As we've seen, people like to focus in on industries. And so that's also a big focus. So I'll pause there and hand it back to you.
Great. Steve, if you can give us a couple seconds here.
Yeah, sure. So like my intro said, I've been practicing for 30 years. I've been doing corporate securities work for about 20 years. And in that role, I've been focusing on buying and selling, representing companies buying and selling. And then also a good portion of my practice is helping companies raise capital. So that's one of the reasons why I wanted to join this panel. I do that through various means, private placements, which I'll try to talk about a little bit later, the legal aspects of that, and then also will represent growing companies raise capital by selling securities to private equity, venture capital. One thing we don't do is I don't do the public securities work. So if I have a company that gets big enough that to do a public offering or an IPO, then I partner up with some of the big firms. But my practice focusing on middle market companies and entrepreneurs rarely gets me to that point. But I got companies that are, bordering on $1 billion of enterprise value. So I'm happy to be here and I look forward to our talk.
Great, thanks. Elliot.
So my background is like a lot, I started in commercial banking. So I the genesis of my training was understanding how commercial banks underwrite credit. But then I moved about a decade ago into asset-based lending and spent time in various different parts of it across the capital stack. But my knowledge is specifically around non-bank debt lending and what kind of sources of capital there are outside of banking when the bank says no. So that's kind of the expertise that I bring on the debt side.
Perfect. And Chris, can you give us a couple seconds as well?
Yeah, thanks, Bassem. My name is Chris Heisinger. I'm a consulting CFO with VCFO. At VCFO, we can provide a team of professionals from senior HR, controller, and chief financial officer positions to help companies fill out their own corporate finance office or help them manage particular projects or transactions that they might be facing. Personally, I've always been on the corporate side of the table, primarily in finance and risk management. I've been through several types of fundraisings, everything from private equity and subordinated debt to asset-based lending and bank financing. So I've seen it all in my career and I'm looking forward to this discussion today.
Awesome. So yeah, you get to see from the other side of the table, it looks like, than most of the other panels. It's pretty good experience. Let's go ahead and start with Brett. Brett, can you tell us a little bit about commercial and middle market banks just in general? Are they open for business right now? Kind of what are you seeing from your side in this current environment?
Yeah, so it's really the long of the short is that in general, banks are very open for business, but it's in different ways. And this goes for community banks, and this goes for kind of all the way up to the large bulge brackets. With the margin compression, with LIBOR being where it is, we saw this many years ago. When you see LIBOR drop to where it's expected to be, and if that's my computer, I apologize. Look, banks need net interest income, and the way they make that is on loans. And so what you're seeing is right now, if you were to put a term sheet out, maybe you have an existing lender, maybe you don't. There's two different avenues, and I'm happy to get into that later. But you're seeing multiple banks, large and small, looking for funded assets. So what does that mean? They're looking for funded loans at the end of the day, and everybody's looking for it. So you're seeing banks who are active in a space that they like, and that's a key. Is it a space that they like? Do they have a history there? Have they had losses in the last kind of 6 months? If they haven't and they want to dig deep, they're going to go long for you. So they'll be a little bit more aggressive. They may try to hold a little bit more than they would have historically. And then pricing, which is funny, we're kind of our own worst enemy, right? Like we need funded loans, and the only way to win deals sometimes is it's a race to the bottom. So banks, of course, existing relationships are key. We do not want to lose our own clients. We want to build from there. And if you're looking at 2021, how's a bank going to hit their earnings? It's going to be a really tough Q4 20. You're seeing a lot of layoffs announced over the last few weeks that expect that to continue with the Fed making signals that rates aren't going anywhere for a while. So the way banks are going to try to do that is fees, ancillary business, other ways they can help you out. So loan only is going to be really difficult, but the way you get into a relationship, right, is generally through the loan. And so pricing continues to be kind of a race to the bottom, candidly, if it's a commercial middle market right way deal. So the answer is yes, we're open, we're active. It's got to be in a space that we like, and big and small, everybody's in the same boat at this point coming out of PPP.
Interesting. Hey, Chris, do you have any, what are you seeing as far as your interactions when you're acting as CFO with banks right now, and your discussions with them about, do they seem open to you, or, I mean, what are you seeing?
Well, I mean, they are open to the right type of client. I think that, credit underwriting is obviously key, they're foremost on their mind. For businesses that are growing and haven't seen a negative impact or even a positive impact on their cash flows in this crisis, there are traditional banking options available to them for credit. I think the challenge is really in businesses that may be struggling with their cash flows, and in those instances, banks are probably going to be a lot more cautious because they probably have loans on their books already that may be problematic, and they don't want to add to that.
You said something really interesting there, which I'm not sure if everybody caught, but you said that their banks are open for companies that have not had major losses or major gains. It sounded like you said that, and that's something that I think sometimes customers are not aware of, is that from a bank's perspective, sometimes having a major gain due to an event that might be considered a one-time thing, it's not necessarily something that the bank feels comfortable to lend against, because it might not be a reoccurring thing. Can from the panel there, can you guys talk a little bit about talking to banks or lenders and making them feel comfortable that any spikes in income or are going to be sustainable? Or how do you talk to your clients or lenders whenever you're talking about changes in the revenue cycle, whether good or bad, and talking about the sustainability of that? If that makes sense.
Basim, I've got a client right now that I'm working with that is struggling with that issue. They were impacted somewhat significantly by COVID, but they had a V-style shape recovery. So their revenues and their margins are doing much better, but they're not back to pre-COVID numbers, and they're actually out trying to raise capital for a management buyout. So it's been a bit of a struggle, but I think that if you have a clear path to recovery, you got a great story, that you may be able to get a commercial bank to provide you with the lending that you need prior to getting to the completion of that recovery. But I think that a lot of the banks currently are taking a wait and see attitude. They're being a bit conservative, which I would expect, coming out of this pandemic. And, so I think that's the real struggle, is that if you have had negative impact, can you get the kind of level of financing that you may have been able to get previously before you get back to full recovery.
Interesting.
Yeah, quick point there. When you're talking about, getting, I guess, where you were pre-COVID is more critical. Are you a sustainable, durable business? We're looking for sustainable cash flows, right? Do you make a difference? If you were gone, would anybody notice? I mean, these seem really simple and like very elementary almost, but at the end of the day, we're also, you mentioned Steve, kind of waiting to see, and I think that's totally accurate. If it's cash flow type lending where it's debt to EBITDA, you're truly looking at, you can't really go off 2019, but you certainly want to know, question number one is, how did you do during PPP? That's the first thing every credit officer is asking, but you're really looking for pro forma, right? Because a lot of people's recovery has been surprisingly strong. I mean, So the question then becomes, to your point, Steve, we don't know if you're looking for larger deals. You can't, it's really hard to go trailing 12 months. You just have too many bumps in the road. So there is creativity that we're seeing with folks doing kind of a pro forma build out, but we really want to see a quarter. I mean, ideally, we'd love to see 2 quarters post PPP before you really lean in. So if there's anything that is not down their fairway, I think you got to try to get a couple quarters in to showcase to the banks.
Yep, that's certainly the dilemma that we're experiencing.
Yeah, and I just add, referring to the pro forma, I think it is more, it's always been important, but it's more important than ever that if you're presenting to particularly a bank, but really any investor, a case for them to invest in your organization, you need to have a very credible story, a very tight presentation that shows that you have a plan to pay them back or to give them a return on their investment. And you really need to make sure that all your I's are dotted and T's crossed in that presentation.
Yeah, not to put you on the spot there, George, but do you have anything? I know you're a former credit officer and running a commercial banking team as well. Anything that you might want to add to that? You're on mute right now.
Sorry, Sam. I've got 2 of the Zooms going on at the same time, trying to soak it all in. But no, I concur. I mean, one of the things that we know. Can you guys hear me? Okay.
Yeah.
So one of the things that we are going through and dealing with right now is really being there to support our clients who have been there with us for a long time, but are not doing well, are losing money. And so one of the things that you were talking about, Brett, was, you're not going to get there through loans and looking at things holistically and fees, et cetera. And we know through watching CNBC in the public markets that M&A fees have been just through the roof. I think $60 billion or something like that year to date, which is the best, I think the best in history. But it's also a time for banks to support clients and not throw them out, throw the baby out with the bathwater, and be fair to weathered friends. So I can tell y'all that we are taking it on the chin on behalf of some clients and losing money every month because we're not charging enough, but that's okay. Because we have to look at things through the big picture, through the big lens, and say, okay, down the road in a 10-year cycle, we're going to be fine. So that's what I would add, is that it's really important to us not to look at things in a vacuum and just say this is a 6-month cycle or 3-month cycle or 9-month cycle, but a long-term relationship.
Hey, Steve, if I'm in a middle market business and what are my traditional and not so traditional sources of capital, maybe besides banking?
Yeah, sure. Well, obviously we've been talking a lot about banking, and there's only a certain type of organization at a certain stage of development that's going to be right for senior commercial lenders. So where would you go if you were a different stage of development? There's going to be different sources of capital for somebody that is a mega manufacturer that has a ton of assets that they can use as collateral, versus a startup company that's just getting off the ground but has a great business plan. So just going from the different stages of development, we can talk a little bit about what the different sources of capital are. So if you are a startup, for example, and you've got a great business plan, you've got technology that's going to disrupt the market, but you don't have any capital. So what do you do? Where do you go? The first place you're going to go is to your mom and dad. And if your mommy and your daddy and your rich uncle and have any money that they can provide you, that's the best source of initial capital for a startup. Friends and family are the best and probably the easiest initial source of capital. So if you can get that and grow your company to a little bit larger, maybe have started to develop your technology, getting ready to do a beta test on your technology or some piece of equipment that you've designed. The next probable source of capital would likely be angel investors that you can get excited about your business plan, and then and that source can come pretty, I wouldn't say easily, but there are a number of angel networks all over the country that you could try to source, make presentations, and try to get them interested in your business. Once you've got capital from that source, you've done your beta, you can then potentially, and you started to do some sales, you can then go to alternative sources where you can do some asset-based lending sources that Elliott could provide, or factoring. You could factor your receivables. That could provide a source of capital. So, and that allows you to continue to grow to another stage of development. At this point, you may be a candidate for the next level of financing, which could be private equity or venture capital. Venture capital is very excited about disruptive technologies, even if you don't have profits. You know, venture capital is interested in getting involved with startup technology companies that can show a strategy of significant growth. The next level would be private equity. And then now you've got revenue, you've got assets, you've got collateral. I think this is the time that you can go to your senior lender and get capital. So I think those are the major sources of capital. And then it all depends on the stage of development of your organization.
Great.
would,
Elliot, you think you give us?
Yeah, I'll jump in. And specifically on the debt side, you know, my background expertise is really understanding the different types of assets that businesses have, and then the appropriate collateral lender to leverage those with. And so everything I've done really in my career has always been debt, and it's always been backed up with a certain type of asset, whether that be a revolving asset like accounts receivables and inventory, or whether it's equipment finance like a leasing structure. And then now really the focus has been real estate. That's originally my background, and kind of where we saw the need in the market was a standalone real estate lender who focused on owner occupied real estate. And so what we're really talking about is taking an illiquid asset and turning it into a liquid asset. Now it doesn't, it depends on what that asset is and what the source and use is, but there are lenders out there, non-bank lenders out there, that will look at all different asset classes and provide you liquidity against those assets. You know, Steve mentioned factoring companies. I was in factoring for a long time. There's the whole gamut of anything from a bank factor all the way to a private factor, and they specialize in different size transactions and have a whole varied pricing matrix. There's lots of equipment leasing companies that look at anything from rolling stock to yellow iron, computers, you know, all that, and they'll kind of specialize in certain assets. And then on the real estate side, there's companies like us that will look at really predominantly the value of the commercial real estate as the primary way that we're making our decisions. You know, we'll look specifically, what we do is we go and look at companies that have had some operating company issues recently. So I would say that they're not systematic or pending on Chapter 11 bankruptcy issues, but they are called a temporary operating company impairment, where it kind of kicks them out of banking, because banking and bankers in general are cash flow and covenant driven lenders. And so when a company cannot comply with loan covenants, whether that is trying to take on new debt or whether that is existing bank clients, banks, you know, they are regulated. And so they have to risk grade their clients. And if clients cannot comply with loan covenants, then the risk rating goes up, the bank's cost of capital goes up, they have to reserve more capital. And so those clients become unprofitable for banks fairly quickly. And so the bank looks for a solution, and sometimes somebody like us is the solution because there's adequate assets to back up a transaction. So we'll come in and we'll provide liquidity against real estate and generally pay off a senior bank, and in probably half of our cases, provide a cash out to the operating company. But whether that's, you could do the same thing with if you've got a bunch of yellow iron. If you got $5 million in yellow iron and no debt against it, there's equipment leasing companies that would love to cash out on that asset and provide you liquidity. And factoring companies, the same, whether it's a factoring company or an asset-based lender, they call it different things, but it's the same thing, lending against AR and inventory. They don't care about your profitability generally. They care about the quality of your client base, the quality, what they call a debtor. So if you're selling a product or service to a good quality client on credit terms, there's access to capital there, regardless of your financial performance of your business. And so happy to answer any questions about that, but that's my experience.
But then let me jump back in for a second and just talk about a recent, I wouldn't say recent, but the last couple of decade phenomenon. Private equity has created a whole nother source of financing or capital in the debt arena. Private equity doesn't always just provide equity financing. There are private equity funds that provide debt financing, and they're doing it in competition with senior commercial banks, and then they're also providing debt at a little bit riskier levels, but at higher rates. So it's an interesting new source of capital that may not have been there 20 years ago, that has kind of changed the market for senior lenders a little bit, from my understanding.
Also, Steve, on those types of deals that you're seeing, I mean, how frequent is it that that debt will come with like a warrant or something like that that will turn into equity in the future?
Yeah, there's a type of debt financing or type of debt finance lender that will ask for not only a coupon on the amount that they have lent, meaning an interest rate, but they'll also ask for an equity stake in the company. And usually that is given through warrants. Senior lenders don't operate in that manner, I don't believe. So you would be going to the non-traditional lenders that would be providing you capital at a higher interest rate and asking for a piece of your company because they're going to be taking on some more risk, higher risk.
So Steve, when you've seen that, what levels of equity have you seen lenders? And I know it's going to range from really low to really high, but if they're primarily a debt provider that also wants to nibble into the company, what's maybe the median or the range for those equity?
Yeah, it's smaller than I think you would think, and it's been a while since I've done a mezzanine style lending transaction, but I believe the last one I did was like 2.5%. 2.5% in warrants, but they could go depending on how risky the situation is. I would expect that it could go as high as 10%, somewhere between 2 and 10%. There are probably other people on the panel that could comment on that because I just haven't done one in a long time, but that's my long range experience.
I was involved in one several years ago that did involve outright warrants, but essentially it was a mezzanine debt structure that had a 10% interest rate. This was in the energy space, so it was for a development. And they had, in addition to the coupon, a waterfall structure where up until they were targeting, I think, 20 to 30% return on investment. And so they had a waterfall where up to 2x, they got, it was like, say 20% of the profit. After 2x, it went down, and then it tailed out at about 5%.
Yeah, that's very rich.
Yes, it was a pretty risky project.
Yeah, I mean, so it sounds like there's some interesting tools out there. Chris, maybe from a CFO's perspective, can you give us a little bit of an idea of a company that might be struggling to find capital in this environment, what they can do?
Well, I think as the other panelists noted, factoring, both purchase order and receivables factoring is somewhat indifferent to the financial health of the company. They're more interested in the financial health of the person that is going to owe the company money. So that is, a viable option for companies that are experiencing a short-term cash flow crisis. Obviously, it's an expensive option, but it is an option. Aside from that, you can, there may be, it depends on the size of the company, but there may be people who are willing to do, second tier or mezzanine debt for a company, provided that they have enough assets to back it up and they're large enough to make the deal enticing to the individual. But for really small companies, their options are probably, aside from the factoring, injecting capital in themselves through their personal sources, or getting friends and family to help them along during this time. But that bears its own set of headaches.
Hey, Bassem, this is Brett. Just a couple quick comments. Completely agree. I think what we see on the bank side a lot, and maybe it's not startups so much that I'm speaking about, but I'm talking about those smaller companies, sub 100 million revenue, oftentimes way less than that, who have a track record, and then they're at this real growth stage, and they did the friends and family that Steve mentioned, and it's like, what next? It's almost a Shark Tank conversation, but with a senior lender, right? It's, I don't want to give up equity per se. I don't want to pay 15% coupon, maybe with some warrants. Is there a silver bullet that you guys know about? And I guess the question generally comes down to minority ownership from a private equity standpoint. We have seen an increase, and just to mention another idea, in the SBIC space, small business investment company space, debt and equity. And these are folks that on either side work, they're SBA approved. And so you're talking smaller businesses here. And they look kind of for this $3 to $10 million EBITDA type companies, and they're willing to put in minority. They don't want to own 90% like a typical private equity shop. So something that just wanted to mention, SBICs.
Yeah, in fact, I represented one about 25 years ago, and my recollection is that they will do both debt and equity financing. So, and they're willing to take on a little bit more risk than they may have the traditional senior lender would, because a portion of their proceeds are coming from the SBA program. So for every dollar that you invest in your own fund, the SBA would provide you, if you qualify, $2 to $3 on top of that to invest, and then the SBA becomes, in essence, an owner of your fund. So they'd be willing to potentially take on something a little bit more risky than a traditional senior lender might, because they're using somebody else's money, the government.
It's a beautiful thing.
Yeah.
Elliot, can you talk a little bit about companies that have been impacted by like the COVID-19 and how, they might be able to work with existing lenders, or that might have retracted a little bit, or what they might be able to do in those situations?
Sure. We have kind of a unique perspective in that the majority of our referrals come from banks, and we are also funded. The majority of our funding is from bank lines. So we kind of work both ends of the spectrum, which is getting bank referrals, whether that's a new client or an existing client of the bank, or convincing our senior bank group to lend us money on transactions. And what we've seen is that it really depends on the industry you're in right now. There are most definitely cold industries where banks have effectively shut the door until they see some clarity. And then there's industries where it's kind of business as usual. And I think you can probably read between the lines that anything that's affected by COVID is dead right now in banking. Anything that's retail, restaurant related, energy sector, what we've seen is a hard stop in the banking sector on financing new transactions for that. And so we're seeing quite a bit of those type of referrals. Anything that's been impacted by COVID, where the bank, those borrowers probably pre-COVID were somewhat weak, and they just don't have the retained earnings or equity or backing in order to kind of get through it. And so those transactions are being pushed out by banks right now. And and even on our side, there's been some reticence on our bank group to finance transactions when our client is in, let's call it, the energy sector, regardless of what the real estate is. The real estate could be an office warehouse. It could be a tenant that occupies that is any tenant can occupy that real estate, but just because our current client is in that space, we're getting a little heartburn from some of our banks on that. And, that's fair. And so I think it's kind of like the different stages of accepting grief. You just got to kind of accept that. So if you're in one of those sectors that is challenged right now, going around the banking network for new credit right now is probably not a good use of time. And so I would kind of go right into the second tier sector and look for debt. If you have assets, you would need to look for debt against those assets, or find a fund that likes to invest in distressed companies, and that could be an option. I don't know a ton of those, but we do get some solicitations from some of those folks.
So Elliot, I have a question for you. So as a commercial real estate bridge lender, are you taking out deals from special assets groups? I'm assuming from banks. I'm assuming that's what happens, but are you sometimes stepping into that position of maybe a lifeline and providing cash out or anything like that? Or is it strictly, are you just taking out real estate and that's it? Is that a source of capital?
So I would say that more than probably half of our transactions are existing bank clients, and all of our deals have been refinances so far. And half of those cases we're providing cash out to an operating company, and the other half is just purely a takeout from the bank. And so we have special assets officers from banks reach out to us about credits in order for us to take them out. We have, sometimes it's the existing commercial lender who originated the credit. It hasn't quite got into special assets yet, but the existing banker will look at that deal and say, gosh, I've got this distributor. We've got a distributor. Normally it's a $100 million in revenue company. Right now they're trending 40% down. They're violated their loan covenants. But gosh, they have this piece of commercial real estate that appraised at $6 million and they only own 2 on it. And so it's an effective use of, it's an effective transaction for that banker to come to somebody like us and say, look, we've got this great real estate. It's just an office warehouse. It's not specialized. What can you do? And so we'll go and look at that transaction. We'll say, if we like the real estate, we'll come in, we'll refinance the bank, take them out and provide cash out. Now we're conservative on our loan to values though, because what we're really looking at is the asset. So we're not going to go high advance rates on something like that. We're going to max out at 60 or 70% LTV. So that way we have enough headroom in the equity in the real estate in the event that something bad happens at the operating company level. But yes, I mean, half of our deals are cash out refinances and half are just pure debt swaps.
What are you, Elliot, what are you seeing as far as the real estate market goes? Because I mean, some of the companies that are most affected and might need to take advantage of, for example, non-traditional financing, like leveraging their real estate, for example, might be in the retail sector or some of these sectors that are hard hit by COVID. And I'm assuming that the real estate values have gone down, and how is that affecting their ability to actually access capital when that asset might not be as valuable right now?
Yeah, it's a bit of a moving target. So we don't get into too specialized of real estate types. So we're not going to do special purpose real estate. So I can't really comment on that. But what I can comment on specifically is in the Texas market for owner occupied real estate, predominantly office and office warehouse transactions. That's mostly what we've done. And we've seen about a 5%. So we have existing appraisals on a lot of our deals from 17 and 18. And then we always order a new appraisal. And we always bid that appraisal ourselves and get a non-biased opinion on value. And we've seen them come in at about 5% less or so than previous years. So there has been a haircut across the board, and it's in that appraisal. COVID uncertainty, it hasn't been a massive devaluation, but the flip side of it too is the last data that I saw on days, inventory days on hand for owner occupied office warehouse under 50,000 square feet is still a very short supply, a very short time cycle on selling those properties. And if you think about it, the reason why is that, developers don't build single tenant 20,000 square foot warehouses. They build big, tilt wall industrial parks. And so owner users build those properties, and there's still demand from owner users for a small office warehouse, at least so far we've seen. So we feel pretty comfortable with that space, that if something happened, we'd be able to sell the building, at the LTV we're at.
Interesting. Okay, well, I want to take a pause real quick and, before I continue on with questions, like see if we have any questions from the audience. No. Okay. Well, maybe Brett, can you talk a little bit about what are some creative solutions for growing privately held companies to access additional capital if needed?
Yeah, I would say different banks specialize in different things. Some have community capital groups, some are large, some are small. If you have, somebody mentioned earlier, let's talk somewhat established companies. They don't need to be 25 million EBITDA, but a lot of owners own the real estate. And they're also personally very tied to that real estate, right? There's something about owning your own facility, owning your own office space, but it should never, that's easily, since somebody alluded to it earlier, it's an easy area to take some equity out, use some of for growth capital purposes. And so different banks, or even usually it's non-banks, but there are a small handful of banks that do kind of a structured real estate approach to some kind of owner occupied real estate. And I'm really talking about maybe a sale leaseback. You see a lot of larger companies do this, right? With office buildings that they own. You saw JP Morgan do it about a decade ago for all of their office space, but you also see it on the smaller end. I'd also mention things like if you are expanding, so this is folks that aren't at so much strapped for capital, but if you're expanding, you look for things like new market tax credits. So these are areas where if you're going to build in kind of a low income area outside of your normal metropolitan space, do not ignore this, because technically you can save 20 to 25% of your project cost if you check a bunch of boxes. But box number one is, where's your address? And it's a very easy way to check online or check with a bank. And they can tell you, is this a lower income community? Are you going to hire X amount of jobs? Are you going to train up those folks where they're making more than the quote unquote living wage, which is also something you can Google. And we're talking about a lot of hourly wage here. So the bar is not high, the bar is low, but there are all these, they're called CDEs, and these investors who are out there who've been approved by the government, who are waiting to inject capital in the form of equity, essentially. That is, you won't have to pay back. At the end of it, it's a 7-year tenor. But long story short, I don't need to go into too many details, but think of creative things like that. If you are expanding, or if you have existing real estate, there's ways to take money out of it. And I'll pause there because I'm sure some of the other panelists might have some other great ideas.
So, Chris, have you ever worked with as a CFO, like an expansion into a new facility like that, where you've gotten some government tax credits or something like that? And then if so, how did you go about looking into those besides just, Google research? Did you have somebody advising on that? Or, do you have any experience in that area?
I don't have any direct experience with moving into, these the new market tax credits that he's referring to. I've been involved in government-backed lending, through the SBA program, but no direct experience with moving into an area that is, targeted for economic development or job creation.
Okay. Steve, do you have any experience in that? No?
Unfortunately, I don't.
So Matt, I have a question. If it's okay. So I was going to ask the panel about companies. It's not about tax credits, but it's about companies that have done really well in the past, but happen to be struggling right now and I'm thinking of some Bank of America clients, but companies that have been really, really resilient and really profitable. But right now, because of the coronavirus, obviously we know Tillman Fertitta raised, a $250 million bond and is paying 15%. But the question to the panel is about access to capital to these kind of great brand names. Is there appetite from the investor community or private equity community or any other community that is willing to put some chips into a great brand name that may be losing money, that's not doing so well right now?
Well, George, I would say, I mean, my comment to that is sort of what Cody was talking about in his speech, that, there are opportunities that arise out of crisis. And if there are private equity groups, other investors that are looking for opportunities to possibly provide equity capital to those companies and get it at a low price because of the impact of the pandemic on that company, then these are those opportunities. So I suspect that there are people out there. Commercial banks are not going to be those sources of capital. They're just not. They're much more conservative. So you've got to find the individual investor, the high net worth individual investor, the private equity group that has a willingness to take or has an appetite for risk and is willing to take on the risk at a higher premium and will make those investments. So I suspect that, and I'm hearing about it, but I'm not seeing it as much. I'm hearing about all the people that are lining up to take advantage of all the opportunities that are being created. But in my experience, I haven't seen it yet, but I know it's out there. I just know it is.
Thank you.
One
I
of
think and this is just anecdotal. I have no direct experience with this, but every time one of this, it happened in the energy sector. There's all these funds that supposedly have billions or hundreds of billions of dollars ready to invest in energy assets that they think are quality, and it always seems like they say they're going to go do it, but then very few deals trade hands. And I think that there probably are distressed investors who are looking for deals. My sense is that they're looking for larger deals. The J.C. Penney's or just large deals where they raise a lot of money and they can do one transaction and get a good return on their investment. I think the challenge is for the companies that need $1 million or $2 million, finding those investors that are willing to invest money at that deal size.
And to Chris's point, this seems like as good a time as any to bring up the whole Main Street lending program from a bank standpoint. And some of y'all may have a lot of experience with this, so I'd love to hear about it from the non-traditional bank side of things, because the frustration, right, is that the big banks, all banks in an umbrella, are not providing them. And given the experience with PPP and the fact that there were 47 different amendments going out with kind of the goalposts moving after the fact, definitely got banks spooky. There's no doubt about that. But at the end of the day, to use that cliche, we have not, if you look at the Houston Business Journal or just statistics, of the billions that were approved, we're only at like 5 to 10% that's even been deployed. And that's extremely frustrating because what George, you mentioned, and this, you're on a bank, that is what this was designed to do. It's that $1 million+ level, right? It's the loan sizes, or the minimum. There's 3 different facilities, right? And 2 of them have $250,000 minimum loan sizes, and they go all the way up to, well, 35 million, I think 50 million and 300 million. So technically speaking, they were designed also for energy companies. And that's given I did that for kind of 6 or 7 years of the 20 years. So many ex-clients will call because banks have, what do you do, right? If you can't sell your asset, you don't want to do that right now at a low valuation period, unless you have a gun to your head, or you're able to, in an energy case, you can sell your midstream that has value and focus on your upstream and just buy time. But the Main Street's been a real disappointment. I have found, however, that certain banks, smaller banks, generally speaking, with maybe even newer banks that have a cleaner capital structure, are specializing in industries. Like a bank out of Fort Worth that a former colleague went to from JP Morgan, they've got transportation interest. So anything that touches transportation, I'm sending all our Main Street deals to them because I can't do it. And the one thing you hate to tell somebody is, I can't provide this for you, mainly because we're super spooky about PPP, right? That's not a very good answer. And so anyway, I'll pause there, but I thought it was worth mentioning.
I think I've got some comment on that because we've got a deal working on now, and this is in particular the Main Street loan program. We have a deal that where we're working on a real estate transaction, and kind of the post-closing capital stack, the way it looks, is going to determine what the Main Street loan is, and it's interesting. The deal originally we proposed it at an LTV we felt comfortable with, where we didn't really feel like we wanted to push the LTV on the deal because of the distress of the company. And they were promised $1 million Main Street Main Street loan post closing. And then the bank came back and I don't know the details of it, but the bank came back and said, sorry, we're going to have to limit this to $500,000. And so naturally the borrower pushed that on us and said, well, hey, can you just increase the LTV on the loan? To which we said no. So now there's this gap, which is kind of effectively paused the deal until there's a potential other solution. And so there's this need for a small mezz piece or an equity piece. And, that's really challenging to find for that check size, $500,000 to $1 million. There's just not a lot of interest. There's no institutional interest. There's only, that's even not even family money interest, family office interest. So it is, we don't really have an answer for that besides maybe working with the existing bank on structuring a note to hold that $500,000 and take, an all business assets or subordinate lien to the other lenders and, short-term amortization or something like that. So what we're seeing is there's a lot of, there's a lot of desire, I would say, from the banking side to work with their borrowers and try to help structure credit. I would say that banks have been really good to work with in that regard. But there's very few kind of simple, clean transactions where you just pay off and everyone's happy, everyone gets their first lien. There's intercreditor agreements, there's back and forth, and you just have to be prepared for that. One thing I would say that to any of the folks that are listening in that are at operating companies now that maybe have an interest in where they're going to go for capital right now in this environment is the most, I would say a thing that we see that's frustrating is that we see borrowers spend a lot of time talking to banks, just going from one bank to the next bank to the next bank and getting told no multiple times before we have a saying for it in our industry, it's before they're tenderized enough to realize they're not bankable. And it's an incredible waste of time. And so my recommendation is to engage with somebody like a Chris, or even any banker who's willing to take the time to help share maybe they can't share their debt service spreads, but they can share how they're coming to their decision. But banks, by and large, use the same formula to calculate EBITDA and what free cash flow there is to service debt. And so the earlier you can find out that you don't meet those metrics, the earlier you can move on out of banking into the private lending world, whether that be debt or equity. And so my recommendation is find somebody who can do that for you, run the spreads on your business, and you'll know whether you'll bankable or bankable or not. And if other panelists have something other than that as input, I definitely welcome it. But we just seen a lot of time over the years spent on people trying to convince a bank that they're bankable when the bank's never going to say yes. So
yeah, Elliot, I've had that experience before where you're telling a client that it's just a little bit too early or too much risk in this particular deal for a bank. And the problem is sometimes you'll have bankers that are really optimistic or really trying to get something done at other banks, so they'll kind of lead them along and tell them that, hey, what we think we can do something, and it doesn't get done. And I think you're right. If you can get somebody that's willing to kind of sit down with you, go through the different metrics that the bank is looking at. even if that banker's bank won't be able to do the deal, he should be able to tell you if it's a bankable deal, because there are some nuances between banks, what they'll be able to do. But I think you're right. If you can get some good advice up front, you can save yourself a lot of time, because you know customers a lot of time, well, clients a lot of times they don't really understand what the banks are looking for. And I mean, as a banker myself, I feel that's part of my responsibility is kind of educate the client as much as I can and kind of walk through those discussions. And so you're right. You can really waste a lot of time if you don't fully understand what banks are looking for. And a lot of times, the time that you waste can be critical into getting a deal done, because sometimes they're very time sensitive. So, um, yeah. Anybody else have any more comments on that? I mean, I don't know, Brett, if you.
I have a question related to this. So my business has a facility with several banks in it, and one of the things that we've asked is their revenue targets. We want to make sure
Yeah, have any.
that they're making money on our deal. And so I wanted to ask about that. If for someone you're banking now, is that a fair question for us, the client, to say, well, what are your revenue targets and how can we help you get there?
I think it's from a senior lender standpoint, I think that's a very fair question, because the answer is going to differ from every single banker, not only every institution, but it's going to differ for every banker, right? Everybody's got their own approach. Some are going to be very handoffish. That's not my personal approach. Let's just call it what it is, right? The best CFOs, whether it's one bank or multiple banks, keep somewhat of a ledger on all of their different wallet business, right? Everything from credit cards all the way down the merchant spectrum to interest rate hedging there's 30 different things or more, candidly, probably more like 60, that a traditional bank offers. And if you're not keeping track of that stuff, you need to always know where your fees are going. And a bank needs to tell you, hey, our hurdle is X. If it's loan only, this is a real big struggle. If it's LIBOR plus 150, we're going to need to see this kind of activity in the next year. Do we have a shot at winning that business from you? And as long as you're candid with them, yes, no, indifferent, insurance business, whatever, they might be willing to lean in.
Yeah, another thing I would just add to that is that, most banks kind of do a risk-based pricing approach, to where, we're assessing the risk of each customer, and then doing basically that drives a lot of the profitability. So to the extent that there's ways to de-risk a deal for the bank, you can kind of maybe potentially increase profitability a little bit. And so, the better that the company's performing, the more secure it is by assets, things like that, then there are some opportunities to kind of de-risk a deal a little bit and increase profitability for the bank. But I mean, I think it's a fair question to talk about. What the bank's hurdles are, and like you said, it's different for each bank, each division of the bank, different bankers, things like that. But I mean, I think most bankers in the commercial space are looking for a holistic solution where they can kind of bank the entire relationship. And like Brett said, a lot of times the lending is probably like a loss leader, and so they're looking at other ways to kind of keep profitability. Does that kind of answer your question, Eric? Okay, perfect. I just wanted to give you guys a heads up. We're about a minute or two away from the next session. So Bob has reposted the link to the virtual, to the larger breakout next speaker in the chat. So if you guys need to reconnect there, we'll probably keep it on here for a couple more minutes. I don't know if anybody has any other questions right now, but if not, we might take one more question to Steve. Anybody else have any questions before I kind of start with our last question? Okay, Steve, this is kind of, maybe you can talk just real briefly about private placements and what a accredited investor is, why that's important, and any kind of laws we might need to be concerned about when they raise new capital.
Sure. So real quick, I think we got about a minute. So we've been talking about bank debt, right? So what if you want to sell your equity. If you want to sell securities, what laws do you need to be concerned about? So if you're a private company and you're selling your securities, the law that you need to be concerned about is Section 5 of the Securities Act of 1933, which says that every sale of securities has to be registered with the Securities and Exchange Commission unless there's an exemption available. So if you sell securities, they're either registered, exempt, or illegal, okay? And there's a number of exemptions that will be applicable to your sale of securities to raise capital as a private company. And the biggest being under Section 4 of the Securities Act, which says that any offering that is not a public offering is exempt. So how do you determine whether or not you're doing a public offering? There's a lot of case law that helps, but there's also safe harbors that the SEC and the legislature has provided, primarily Regulation D. So if you follow the rules of Regulation D, then you will be deemed to be exempt from registration. And the biggest safe harbor under Regulation D is that if you sell to only accredited investors, you can sell to an unlimited number of investors and an unlimited amount and raise an unlimited amount. Now, you will potentially buck up against the possibility of doing a general solicitation if you start soliciting too many people, too many accredited investors. So if you do it, the Regulation D does prohibit general solicitations, and if you do generally solicit, it becomes a public offering. So in summary, you need an exemption to sell your private securities. There's plenty of exemptions available. You need to talk to me about what works for you. And selling to accredited investors is one of the biggest exemptions available, provided you don't do a general solicitation.
Okay, great. Well, I appreciate everybody's time today. I think we're about out of time. So I'm going to just what I'm going to do real quickly is put up everybody's contact information one more time. If you want to reach out to any of the panelists, their contact information is right here. I can forward this out to everybody in the group or whoever needs it. Just take down my email address and I can forward it to you here. But since this is also being recorded, I want to have it on here in case somebody that is watching the recording decides that they want to reach out to one of the panelists as well. But thank you guys all for your questions, your participation. I think it was a lot of interesting information there. Hopefully it was some value to you guys. And thank you again for all your help, and look forward to speaking to you guys soon. And please enjoy the rest of the panelists and the discussions today.
Thanks.
Thanks, Tim.
Thanks for hosting.
Great job.
Thank y'all. This was great.